Good evening, folks. This is a quick review of the euro dollar, and I'm going to give you some ideas about what I might see in analysis going forward. And it may not be of any value to you because obviously the large move has already transpired today. Okay, so I'm readily admitting that this is hindsight. I did not participate in this move at all. Was enjoying the day away from the market, so I've already made my PIP quota for the week. And this big move of the week wasn't necessary for me to be a participant of, for me to do very well this week. Okay, so first things first, we have a few classic chart patterns in here. I want to kind of go over that before we go on anything else. And we'll just do this. I'll use the little X here. All right, so we have this high, we have this high, and we have this high here. And inside that pattern, this is a classic head and shoulders pattern. Okay, and nothing terribly exciting about that, but I kind of like want to draw your attention to that. And also on a larger degree, if we go a little bit bigger on that, not just that big of a difference, is it? I want you to take a look at this high. So now we have head and shoulders, and then a larger head and shoulders pattern here. Okay, so we could possibly see a move. Okay, we'll just use we'll go with that as our neckline. Okay, and the reason why I'm doing that is I'm looking through the wicks. I'm trying to get an idea of how many times I can get multiple touches. And I'm going to use that 1705 level. So I'm going to use 1705 just to round it to a 5 level. And we're going to do a projection from the high all the way down to the neckline. Okay, so I have this move here, and now we're going to project it from that break of that neckline right here today. And that's going to take us down into about the 1320 level. Okay, so 1320 could be potentially where we go. And you look at the movement on this neckline, we basically have already fulfilled this head and shoulders pattern, break of the neckline, and we've hit it today. So that's actually been complete. But from an intermediate term or a little bit longer term perspective, we could see 1320. I'm not saying it's going to get there overnight, but I probably shouldn't say that. It'll probably end up doing it now that I said that. But we could see 1320 on a little bit longer term basis. Okay. So with that, I'm going to drop down into a little bit lower time frame and kind of look at something today and go over something for you as an example. So we're going to drop into an hourly chart per euro. Okay, so we have the 60-minute euro dollar chart. Okay, and I want you to look at this price action here. Obviously, this is very exciting. Everybody wants to trade these types of things here. Okay, and I'm not going to give you the false sense of expectation that you're going to be able to do these types of trades here. This could very easily have gone higher on the ECB announcement and press conference today. Okay, so you got to be very, very careful when we're ahead of a big rate announcement, FOMC. It could be very dangerous if you don't know what you're doing. So to be responsible as a mentor, because I know a lot of you folks are listening to me and you're going to do things I'm telling you not to do because you're trying to chase money, chase pips. I knew if I stayed in front of the charts today, I would probably make comments about what I thought was going to happen, and I don't want anyone taking trades on that, getting themselves hurt. So I took a great deal of liberty today to keep myself at bay. So without making this video too long, I want you to take a look at this, okay, and consider the pattern I've been teaching you, and that way we can go through price action and see one more example of this occurring, but I'm going to kind of like supercharge it tonight. I'm going to give you a couple different things to amplify it, okay? The system itself, the method itself hasn't changed. It's not morphing into something entirely different, but it is going to start bringing in some other ICT concepts like the order blocks, okay? And I'm going to help you get to why I was looking for certain things to happen, and also why it failed to get to where I thought it was going to go, but still it's a good thing, okay? So I want you to look at this chart, and where did we leave it in terms of a high? We left it back here, okay? And I want you to take a look at these last two up close candles, okay? Because these are like voodoo, okay? When I named my candle pattern to help identify institutional setups and entry points, I came up with just a simple definition called an ICT order block. And the reason why I call it the ICT order block, and people are now using them all over the place, they call them blocks. They want to keep it short because it sounds like it's theirs. But it's the ICT order block, and basically it's the last time we saw a large degree of institutional selling, and institutions have to sell as price go up, and when prices go down, institutions have to do their buying on that basis. They cannot do any other way. Okay, so they have to see it go up to go short, because they have to reach into a pool of liquidity or draw in buyers as they sell in to that move. Okay, so they fade the high and they fade the low. So all we have to do is look for where price has shown a willingness to move away with a strong degree of magnitude. Now, magnitude is how far it moves away, okay, and then speed also is a definition that helps find these hallmark little footprints, if you will, of smart money. So I want you to take a look at the last two up close candles in here. Now, don't look at these little things in here, because they're going to be problematic if you do that. You want to look for these really obvious, big, bulky candles, okay, on the up close, right inside the highs. Now, it could be the very high, or it could be a candle or two before the very high. Okay, all we're doing is looking for the last series of up close candles, because that's going to be the ICT bearish order block. I really should have called them voodoo blocks or something like that, because then it probably would have been really cool, and it probably would have been much more intriguing. But a lot of folks just think that this is not of any value, because they look at every up close candle and assume that it should be a block. There's specific definitions and details that go along with making the order block what it is, but I'm highlighting this one here because I'm going to be mentioning it in future tutorials, and I want you to see how it was catalyst for today's move over here. Okay, so also I want you to take a look at how price moved up to, I was calling for the next upside objective to be 118.40, and then should 118.40 give way or trade above it, I was looking for a move above these equal highs, and that would take us around that 118.60 level. Now, obviously, we didn't get there. We did go to my 118.20 to the pip yesterday. Didn't go one pip above it. Went right to 118.20, and I'll show you that real quick. Right here, this is a new day, so the highest point comes in at 18.20 right there, and then it goes to a new trading day right there. Okay, so precision as it can possibly get. Now, my 1840 failed. It was not arrived, but I'm going to show you why it doesn't make a difference. Not that I was trading it, but I want you to see, if we look at this price range right here, okay, this price range here, we're going to use that to forecast, if you will, another important high. Now, an important high obviously is going to be this one here, but if we want to find a target, why did it go to 118.36? Because these are the questions I asked myself as I was coming up as a trader that led me to become focused on such precision, because I believe that the markets are manipulated. If they're manipulated, therefore there must be someone in control. So if it's in control, then they have an ideal scenario or a template, if you will, of what they think price should do or how it should behave inside a specific time frame. In this case, we're looking at intraday. So we're going to take a look at two areas of price action, okay? And I'm going to draw your attention to this candles body, and it matches this one here, okay, because the open on this one and the close on this candle here are the same, and it's going to be 1735. And I want you to look at the highest candles body right in here, and this is our reference points that we used for our fib. When I did the optimal trade entry OTE primer video on my YouTube channel, we're going to look at these two reference points, this candle here and this candle here. That's defining this trading range. Okay, so these are dealing ranges. So whenever you see price moving in specific consolidations like that, it's going to be rather significant in the future because at some time that dealing range is going to be breached. So when we leave that dealing range, where does it reach for? What's the next level of dealing? And I'm going to show you how to do that, incorporating the optimal trade entry and bearish order blocks. So I'm going to make it real quick and save myself a whole lot of time. And boom, there you go. So now I have this low and this high referenced here. The fib is drawn up on those reference points specifically. And here's the ICT bearish order block, the last two up close candles. And we can see here that I have a reason to go crazy about OCD. Got to keep these lines straight, folks, otherwise I'll lose my mind. I was looking for 1840, and the reason why I was saying 1840 was it was the open on this last up close candle. Okay, so 1840 was going to be my objective to reach for. Okay, should we get past 11836? Now, why is 11836 the high? Because it's exactly the symmetrical price swing I taught you with the optimal trade entry primer. That's what makes my fib optimal trade entry, because I'm giving you the optimal levels in terms of how the banks are going to look for confluences. Now, I'm not saying banks are trading with Fibonacci, because they're not, but it has an uncanny ability to overlap with levels that the banks do in fact trade with. And that's these levels back here, because they sold here before and it went right back to it here. Now look at the bodies of the candles respecting that open on this candle here. It's going to be 118.28, and this candle's close comes in at 118.28. This candle's open comes in at 29. This candle's close is 29, and we can see a lot of action around that opening price of the lower of the two up close candles. Two candles back to back can represent a order block, okay, an ICT order block. In this case, it's a bearish order block. Why? Because it was the last two up close candles as they sold into that move, and it moved away quickly, and it had a lot of magnitude moving away from that price range. So we know that there was institutional selling. Institutions are so vast with their orders, they cannot put their whole entire order on up here. So they have to wait for price to come back up to that level, and they sell it again. And they put a larger degree of movement or orders in the marketplace. This level here is exactly our symmetrical price swing. It doesn't go one pip less or above. It goes right to at the high, 118.36. So our symmetrical price swing, it nails that one. But what I was looking for is maybe it might fluff through that number because of ECB and push into 1840, or spike through, run these highs, hit 118.60, and then I would have been expecting a turtle soup or a false break above that high, and then maybe a drop down on the euro. As it happens, it only goes to 118.36, and it looks like beautiful cherry picking, but you'll see these concepts are being referred to over and over and over again, and they're in the same capacity. I'm not changing rules. I'm not blurring the lines. It's the same thing, folks, every single trading day. Now, with this real quick, I'm going to drop down into a lower time frame. Okay, we're looking at a 5-minute chart of the euro dollar, and I told you to start looking at the 7 o'clock in the morning New York time. And once you know the bias, obviously we can see here the market is making a strong impulse to move lower. Wait for a retracement up about 20 pips. Okay, from this low here, we can clearly see that it does in fact trade up higher than 20 pips, but it goes right back to the 62% retracement level, beautifully sells off. Target 1 hit, target 2 hit, and symmetrical price swing eventually hits right here. For a day trade, beautiful example of that. It's all hindsight. I did not trade this, but I'm just showing you again, just to solidify the rules I've already given you. It's not a totally new approach to it. It's simple rules being applied again. You can see here one more example of it happening for the New York Open setup. Hopefully you found this insightful, and until next time, I wish you good luck and good trading.